Welcome to the nuanced world of impact investing, where success isn't just about dollars, it's about change. How do you measure that? Stanford Social Innovation Review breaks it down into 4 phases. First, estimating impact. Before you invest, assess the social return. Use frameworks like social return on investment to weigh the benefits against the costs. Second, planning impact. Choose your metrics wisely. Will you use a scorecard or a logic model? Make sure it aligns with your mission. Third, monitoring impact. Keep tabs on your investment. Use real-time data to measure social outcomes alongside financial returns. Finally, evaluating impact. Once the investment matures, assess its social footprint. Was it worth it? This is where you decide your next steps. As impact investing grows, the call for standardization is loud. So let's not reduce impact to just a buzzword. Make it count. Kevin, the program that you put together at the New Hampshire Community Foundation has continued to grow. When you started it, how did you handle managing return expectations in portfolio construction and metrics?
Well, on return expectations, we actually crafted a lower expectation on return because on financial return, traditionally a community foundation has to earn somewhere between 8 and 9% per year in its portfolio. That enables a distribution for grants of about 5%. It enables 1% for the cost of running the organization and 2 to 3% for inflation. So we took out the inflation portion of it, and then it was a question of how we can come up with a similar portfolio to a traditional distribution of asset classes, and it was really difficult. The most challenging one was trying to find a public equity sleeve that had a geographic focus that somehow touched down in the place that we cared about, which is the state of New Hampshire and by extension, the other New England region states. So that was the toughest one. And then because the investment opportunities in a very small state are somewhat limited, we literally had to build on the relationships that we had with other organizations, with nonprofit housing trusts, with other nonprofits that were looking for capital. We had a very strong relationship with our community loan fund, so we started layering investments on an annual basis into the community loan fund because we knew that they had a 30-year track record. So it's not easy, particularly when we have a geography, in our case, that is only one state and a relatively small one. An organization like MacArthur has a global footprint and has multiple initiatives, whereas ours is the charitable foundations was very place focused, as is my current organization, the Community Development Finance Authority. We're looking to have an impact within the physical boundaries of the state of New Hampshire, and that is by its nature somewhat limiting. And yet it enables us to be creative within that landscape and not be drawn to other opportunities that might seem attractive, but that don't have that don't touch down within our geography.
Debra, in your experience, how does one balance this pursuit of profit and purpose?
So I think that is, of course, a core question. And for some investors who are coming at it from a fiduciary type organization where there's a mandate and regulations that may be governing them, those regulations, that legal and fiduciary context is going to shape how they think about profit and purpose and which comes first. So they may well need to start with, just as you just heard, a really cogent way of thinking about this for Kevin's organization of saying, well, we need this much to distribute grants and this much to operate, and we need this much to allow for inflation. So you start with that. It doesn't, as you can hear from Kevin, it doesn't mean that you're giving up impact. It's just recognizing the financial reality of your organization. A very simple way to put it is no money, no mission, right? So if they put themselves out of business by not paying attention to those parameters, we are all at a great loss, and especially the communities in New Hampshire that look to them. So in some cases, you, like a foundation like MacArthur, we also have fiduciary duties. We happen to have something called the program-related investment, which is permitted under the tax code for private charitable foundations. There's a set of rules around it, and it can be cumbersome from some organizations to make what we call PRIs or to receive them. But we have been doing it for 40 years. We have a track record. We have found that we can do these kinds of very high impact loans, investments, and guarantees. We can preserve our impact investment capital and have the impact that we seek and unlock literally billions of dollars of additional capital that could not flow without the seeding, the scaling, and the credit enhancement that we're able to provide. So for us, we start with impact and we say, let's absolutely maximize the impact of these very unusual, flexible, patient, risk-tolerant dollars, catalytic dollars. Let's start there, of course, staying within the framework. But we are very fortunate that the way we've approached impact investing is to allow the impact investment dollars to be essentially a quasi-revolving fund with a capital preservation objective. So we do make returns on the capital, but we're using that to replenish the losses that will inevitably occur. So if we were very poor stewards of that capital, we would have losses running like crazy and we wouldn't be able to preserve the capital. But what in fact has happened is we've taken outsized risk, we've been patient, we've been able to support innovators, we've been able to go deep with our impact, preserve the capital, actually build a small margin beyond that, and create almost like an evergreen type resource. So that's a different approach, but I am very mindful that's enabled by a very particular and very fortunate set of financial and philanthropic constraints. And every investor, every family, every institution, is going to bring their own lens to this, and they're going to think about, is racial equity or gender or housing or community development or environmental and climate solutions. Every investor, just like every philanthropist, needs to decide where they want to make a difference. And I think the most important thing is not to be afraid to jump in, not to let the perfect be the enemy of the good, to allow space to experiment and learn and find the things that work for your own individual self or for your institution. And as you've already heard from Laura, there are many different gateways and opportunities, community development credit unions, community development banks. If you are an experienced venture investor, there is just an incredible array of private equity and venture funds that have taken shape over the last decade. So that's become a space as well. There are bond opportunities, social bonds. And these are all before you even get to sort of the ESG, public equities space that we talked about at the beginning. So you had a framework in the video. I would just share out again from the Impact Management Project. A is for avoiding harm. And that's what, as you rightly point out, negative screening. That's the oldest form, in some sense, of socially responsible investing, going back to the Quakers and the Methodists, the anti-apartheid movement, now the fossil-free efforts to divest. So A, avoid harm. B, generate benefits to society and the planet. That's also increasingly called ESG or SRI, but that is the affirmative seeking of companies. And I loved the comments at the beginning that those are companies where you're looking like inside the company to say, how is it run? What is it doing? What's its business model? But you're also looking for companies that are not having adverse effects, but are actually generating positive effects through their labor practices, their production, their supply chain sourcing, and all of that. And then finally, C. So A, avoid harm, B, benefits to society, and C, contribute to solutions. So that's what I call kind of the deep end of the impact pool. And that's where you're looking for very targeted opportunities because you care about survivors of domestic violence, or you're really interested in the racial equity wealth gap, where you're finding things that are actually, hopefully, if they're successful, moving the needle toward an actual targeted solution. So A, B, C, and we can have all of those in a portfolio at the same time. There's no rule saying you have to have one approach.
Bruno, any final?
Oh, longer than
go
you
ahead.
needed, Andy. So.
Bruno, any final thoughts on evaluating financial and social return on investment?
Oh, I remember very early in my investment career, one of my mentors said, "Hey, don't forget, good business is good business." And what I take from that is, look, if you run a company well, if you have good management, a good board, good products, brand equity, a good customer base, and a product that solves a problem for the customer, you're going to be in business for a really long time, and there's nothing like a portfolio of businesses that are reasonably valued that look like that. And what I found in my investment experience is that you give up nothing by looking for companies that have those features. And in general, our public equity portfolios have performed extremely well. They're competitive against passive alternatives, and they have a lot of features that are good, in terms of all the things that Debra was talking about, how the employees are treated, how the whole thing works. So, sustainable investing is really, I think, a superior way to get results for clients. It's really as simple as that.
Well, I want to thank all of our panelists for joining us today and really inspiring me and the audience, seeing all the very good work and positive impact that each of our panelists are having. I want to thank the audience for joining our Inspired Money Revolution, one live stream at a time. I encourage everybody to visit our panelists and follow our panelists, support our panelists. Debra Schwartz from the MacArthur Foundation. You can find her at macfound.org. Laura Ortiz Montemayor at svx.mx. Bruno Bertocci, you can find him on LinkedIn. And Kevin Peterson, he's at the New Hampshire Community Development Finance Authority, which is nhcdfa.org. Thanks to all our panelists. To everybody, please join us next week on October 11th. We have a little bit something different. We're moving from impact investing to the inspired home, designing your life with intention. I'll leave you with this. Your homework is to think about profit and purpose, and think about how and where you can make an impact and what's most meaningful to you. Do one thing this week that scares you, because that's where the magic happens.